Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Sunday, August 7th, 2022, and this is Blockhead Traders Weekly. In this week's episode of Blockhead Traders, it's just myself, Sprocket888, and we are going to take another look at that ongoing Apple trade because an interesting situation has just come up this past week, and I want to talk you guys through it. But before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there. It's free to join. You can say hello to myself, any of the other Blockhead traders. Love to hear what you're trading. Love to hear what you want to see on the content for the show. You can also check out a link to thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. But let's hop to this week's content of taking a look at that Apple trade. Now, we've covered this Apple trade a few different episodes. I'll link them in the description below, and you'll find a little link just above in the video. And what this trade is a naked trade on Apple that I have. So recently, Apple reported earnings, and when they reported earnings, they declared a quarterly dividend payout of 23 cents a share. And at the end of last trading week was the time that it was time to pay out that dividend. And that creates an interesting situation for option sellers. It's what's called an assignment risk. Well, you always have an assignment risk, but the risk of assignment is a little bit more elevated when there is a dividend payout coming. And we'll touch on that in a minute. But first, I want to touch on some of that original Apple trade. So let's pull up the whole thesis and the whole chain of events leading up to this point. So the original thesis on Apple was I was bullish on Apple. It was kind of faltering. It was trending down. Volatility was increasing. It was a high historical IV percentage, so it was kind of ripe for premium selling. Now, I'm bullish on Apple long term, so I was okay to take assignment on those shares. So the original plan was that I would sell naked puts on those shares to either profit directly from the naked put or end up taking assignment on those shares. And so I opened the Apple trade with a short 160 put, which said if Apple is trading below $160, I'm going to go ahead and pay $160 a share to own Apple. And I opened that up for $3.46 premium. So I took that $3.46, and I put that in my pocket. Now, open that up in April, beginning of April. As we came out to June, that trade was in the money. Apple was below $160. I was okay at that assignment, but the one thing that I wanted to do was, well, let's just push it out another month because I could collect more premium. So why not kind of cut into that discount that I had going for Apple to just lower that cost basis more? And so in May, I rolled that position out to a June expiration, collecting another $245. Now, that was all well and good, but Apple continued to decline. And it was well below that $160 premium that I was on the hook to pay for. And basically at the end of June, I took assignment of Apple. That was when those options expired. There really wasn't much premium to roll it anymore. And I was assigned 100 shares of Apple. So I paid $160 for each of those 100 shares, keeping in mind that I've already collected a little bit over $5, almost $6 a share on that. Now, at that particular time, I wanted to basically then turn around and sell a call against it. So one of my rules is that I will never ever sell a call against my underlying that is below my cost basis. And the reason for that is because if you got assigned at your strike price, you must sell those 100 shares. And so if you sell that call strike price below your break even, you're effectively kind of rolling the dice that if you get assigned, you're going to take a loss on that trade. Now, I bought them at 160. So you might think your cost basis is $160. Well, remember, I collected almost $6 in premium from those two naked puts. So my cost basis was actually a little bit below $155. So I was okay to sell a call at $155 strike. Now, Apple was probably trading, I don't remember, probably around $130, $135. So I was really deep in the money. So that 155 call was actually pretty far out of the money. I want to say it was around a 20 delta when I sold it. So I collected another $235. Keep in mind, if I got assigned, I would still walk away with a profit because I sold that call above my cost basis and I collected another $235. So at the end of June, I sold an August expiration. Now that brings us to last week's earnings and the dividend assignment risk. So one thing about a dividend assignment is you have to have the shares to collect the dividend. And so remember, I'm the one that holds the shares, so I can collect that dividend. However, in the case of Apple, the person holding the call, they can choose to call my shares away from me, so they own the shares and they can take the dividend. So it's very important when you sell short calls that you pay attention to any dividend early assignment risk, because if that person wants that dividend bad enough, they can exercise their option early to call the shares away from me so that they're holding the shares when the dividend pays out. And so Apple's ex-dividend date was last Friday, which means you need to be a shareholder on Thursday at the end of the day to collect the dividend, because an ex-dividend date means that's the first date that the stock trades excluding the dividend. Thursday is the day where someone will very likely do an early assignment on that share. Now, you can tell from the math here that I wouldn't stand to make a ton of money from the length of time that I had held Apple. Sure, it's a profit, but for the amount of time that I was in the trade, it's kind of not that much. So what I decided to do was roll that trade just before the person on the other side might want to consider an early assignment to get the dividend payout. What that does is that's going to lock in additional premium in my pocket, and they could still take that dividend assignment the very next day, the early assignment. So on Wednesday of last week, I actually rolled my position from an August expiration to a September expiration, effectively collecting another $205 into my pocket. Now, what that did was, if Thursday came and the holder of the option that I had sold wanted the shares, they could call them away. But I snuck in that extra little bit of premium before that day came. So what you can see here is if you add up all of the premium that I have sold, 346, 245, 235, 205, you can see I've collected $1,031 of premium from these Apple calls. Now, I bought those shares at 160, but with this premium in here, my cost basis is actually $149.69. So if I was assigned to have my shares called away at $155, I would stand to make a $531 profit. Now, turns out I actually did not get early assigned for the dividend, and I collected on Friday. Well, they haven't paid it out yet, but I was a shareholder prior to the ex-dividend date, so I will get paid out that Q2 of Apple dividends. Additionally, I still have my 100 shares, and I still am short one $155 call. So what I want to kind of jump into here and talk just a little bit about is, what does it look like for an early assignment risk? What is the other option holder considering when they decide, should they exit early? Should they not exit early? And how are you actually able to roll these trades for additional profit every single month that you want to roll them. How does all that work? So I want to take you through what this kind of visually looks like in the pricing of the option. If you take a look here, I've got my August expiration of the 16 days to expiration. This was the call that I rolled forward into September. And so what does that actually look like? So at the day of the roll, Apple was actually trading at $165 a share. My call strike was at 155. That means that that call has what's known as intrinsic value. And intrinsic value is value that is built into the option that cannot be taken away. It is basically what that price represents. It is intrinsic to the share price. And the way that you understand how much value is in a stock option that is in the money, if it is out of the money, there is zero intrinsic value. If it is in the money, the amount of intrinsic value is the difference between the strike price and the price at which the stock is trading. So in my Apple example here, this option had $10 of intrinsic value. That is value that does not decay. The intrinsic value will change as the price changes, but it is always the difference between the strike price and the price of the underlying stock. The other price component in an option, there are only two. There is an intrinsic value and an extrinsic value. The extrinsic value is the premium. So this is what I actually sell. And this is comprised of time and volatility. Think of this as your insurance. So the longer your insurance covers you for, the more expensive it is. The more expensive the underlying, or the more volatile the underlying, the more expensive your premium is. And when we sell options, we really want to maximize this extrinsic value. And the way that you calculate what the extrinsic value is you take the price of the option, whatever it is in the option chain, you subtract out the intrinsic value. And remember, that's just the difference between the strike price and where the underlying stock is. And whatever is left leaves you with the extrinsic value. And so what you have here is on the day of my roll, this option, my call option, was trading for about $11.77. So that means, well, $10 was extrinsic because that's the difference of 165 to 155, which leaves $1.77 in extrinsic value. Now, if you want to understand dividend risk, this is what you need to pay attention to, because this is the value in the option that whoever does the early assignment is giving up this value in exchange for the dividend. Okay, because once you exercise your option, all that extrinsic value is gone. Okay, you've turned in your coupon, it's shredded, it's done, it's used up. So if you want to know how much early assignment risk you have, you need to pay attention to what the extrinsic value is compared to the dividend payout. So in the case of Apple, they had $177 of extrinsic value. Now, the quarterly dividend payment was 23 cents a share. So 100 shares is $23, which means whoever held that call option is looking at this and they would be giving up $177 to collect $23. Doesn't make a lot of sense. So the early assignment risk in this case with my particular instance was relatively low. Now, if you do this calculation and this 177 number was like $10, or maybe the dividend was much higher, if that value is less, if the extrinsic value is less than what you would get from the dividend, you are at an extreme risk of early assignment because the holder of the option has all the power and they can choose to trade this extrinsic value for that dividend payment. So that is how you can kind of look out for how much early assignment risk do I have. It's never zero because you can always be assigned options early because you don't know what the other trader is thinking. You don't know why they bought that option. They might not know what they're doing. They might exercise early. They might not follow logic. You don't know. So there's always a risk, but you have an extremely elevated risk when that extrinsic value is less than the value of the dividend that is coming up. So the other piece that I want to call out while we're looking at this is, how the heck do you always get it for a profit when you roll your options? And this is the best part about naked option selling, in my opinion, is you have a lot of options on how you want to manage them. And what you see here is in September, for the 155 strike, remember, I'm not changing my strike. I'm just changing the expiration date. We're still extrinsic value, the difference between that 155 and where Apple's trading is $10. Or intrinsic value, right? That's the same. It's the same. It's a wash. In August, it's $10. In September, it's $10. Like I said, that is the value built into the option. However, the premium is much higher in September. Why? Well, in August, these things were about 16 days to expiration, but in September, they're 45 days to expiration. So there's more time. Time equals more premium. More premium equals higher price. And so when I sell the September, I have the amount of extrinsic value in that is $3.82, which means I had to pay $1.77 to close this option out, but I turned around and sold the same thing further out in time for $3.82. Now, the $10 is a wash. Yes, I had to pay the $10 to close that out, but I immediately get that $10 back when I sell the September expiration because the intrinsic value is the same in both. So you're buying it back and you're selling it at the same price, so that's a wash. The difference is that $1.77 to $3.82, which nets me $2.05. So that is how I rolled for a profit. And if you go back and take a look here, the other times that I rolled here, this short put, again, same thing. I kept the same strike price, but there wasn't much time left in the option when I bought it back. And then when I sold the next one, it was further out in time with more premium. And that is how I collected this extra $245 because I pushed it out in time, give myself more time. Eventually, I got assigned. But as I'm waiting, I'm going to keep collecting premium, collecting premium, collecting premium. And once I get assigned, I take the opposite side of that trade and I'm going to start selling calls. And I'm going to collect premium. I'm going to roll it. I'm going to collect premium. I'm going to keep doing that until I get assignment again. So that brings us to the end of this week's episode. I just wanted to take a real quick, brief look at that Apple trade that's been ongoing. We've had 2 previous episodes, Rotten Apple Part 1, Rotten Apple Part 2. You can see I'm still milking that trade. I'm still pulling premium off of there. I wanted to take the opportunity to talk about this early assignment risk and dividend because it doesn't come up very often. But when it does, you want to know, what does this mean? What do you need to look at? How can you gauge how likely it is that you're going to get in an early assignment? And then how you can manage it to squeeze out a little more profit just in case somebody early assigns you. And we'll see how this continues on. We'll see if Apple starts slowing down or if it just keeps tearing up and somebody decides to assign it. If Apple starts to slow down and starts pulling back down to that 155, that'll be great because that will allow me to potentially buy back this option with less time in it. Then sell another one, collect more premium because I'm coming closer back down to my strike. If that doesn't happen, I'm not going to lose any sleep over it because as you can see, I'm already in the green across the board on the Apple trade. And so every time I can sell additional premium against these shares, that is 100% pure profit that can go against my trade here. I hope this gives you some insight to some of the flexibility that you have with selling naked options, how you can manage early assignment risk, what to look out for when dividends are involved, and I hope you found it somewhat interesting. Sure is getting pretty exciting out there in the market. Lots going on. I wish you guys the best of luck this week, and remember, think outside the block.